Hi guys, welcome back. In the month of March and April, some of you may be aware that we raised a series for the investors, and we brought experts from different subjects, and we did a LinkedIn live events on due diligence, NRI investment in India, startup valuation, how to find the right opportunity, and several other informative videos. No. Thanks, first of all, for the overwhelming positive response. It is great to know that many of you found the sessions very informative and useful. No? So this time our focus is slightly shifted. It's about startup founders. How can they make the company robust and fundable? I think that's kind of a top overarching topic on which we are going to focus all our this time series. Of course, this will always ultimately help the investor if the company has the right internal model in place. No, so we'll see each areas of companies and how they are functioning, how they can do it better. We, as the Sen Angels, do a very selective advisory mentoring of the few companies in a year. And we thought that maybe this time we can share our experience through that mentoring and advisory process. No? So the first topic is cash flow management. Obviously, for any company, zero cash, I'm not talking about the profit, but zero cash means company is in deep trouble. Potentially, there is no money to pay for salary or delay in salary to the employees. All of this getting into that low morale in the company, and it's kind of a downward spiral starts. No, so to discuss all this, I have with me my co-founder of Sen Angels, Sriram Sundarvadnan. I could not have found a better person than him to discuss cash flow management. He's an ex-banker and investor come CFO in the early stage startup. So welcome, Sriram.
Thank you, Sanjay.
Yeah. Great. So what we'll do is that, as I think we had done last time, if you have any questions, do put it in the comment section of LinkedIn, and then we will take it those questions, and we will try to discuss it here. No. So Shram, as they say that cash is king, correct? So in a regular life, also daily life, also this is kind of our cash is king. So let's get down to the brass tacks. So many startup founders, when we meet, and you know that about that, when we ask how do you manage their finance, I think the typical answer is the chartered accountant CA, and it's more about accounting. It is more about compliance and income tax and things like that. Correct. So how managing finance is different than the role of CFA, no? CA, maybe that would be a good starting point to discuss, no?
Sure. Sanjay, see, typically let's take a step backward. So when a startup, the idea is being conceived, and in today's scenario where it is more tech-focused startups that are coming into place, founders and co-founders typically come from a tech background, and they have a salesperson, so the go-to-market strategy is addressed. Tech is then built in-house. Then they come up with a proof of concept where the idea is then crystallized and brought into a concept stage. Then typically the sales guys kick in. There is a minimum viable product to test whether you can find your customers. So it validates the idea of the proof of concept. So all these things, the initial seed capital is brought in by the founders, either directly by them or through family and friends. Because if you remember in the earlier session that we had, the initial funding is done by family and friends because it's not on the company or on the product or on the product fit. It is more on the founders. So when that money comes in, it trickles in and typically is used up in the early stages. Once the sales cycle starts, In this case, let me take the example of a B2B company. The sales cycles are really longer. It takes anywhere from 3 months to say to 9 months to crack a customer. And in all these intervening period, the company has to have cash to manage the burn. So cash is king becomes, at that stage, cash is king becomes very imperative. But typically when you look at once the MVP stage has crossed, you've got more customers. One common thing that I have noticed amongst startups is they're able to crack a sale, right? What happens after that? What happens after that? It becomes very, very critical. Most founders either feel shy asking for money, or typically they have no clue, or they cut back on their own expenses. So you starve yourself to keep the company going rather than approaching the customer for the funds for the services that you have provided. It's not free money. So you've done some work and the customer has to pay you. If that is not put into a system, then the drag really starts. At initial stages, the amounts will be smaller. But as you keep progressing, and if this is the same idea on which the company functions, the whole just keeps getting bigger. Now let's take a scenario where a company came into existence in 2019, has spent a year, spent all its money, got its POC done, the MVP is ready, they've got a customer. COVID hits in 2020. Businesses just collapse because they have not made enough money to sustain themselves. That is where companies start to struggle. Cash becomes that much more critical. When you have a defined process by which a customer's reached out, there is a follow-up. You should know how many days of credit you're giving. After that, there should be a robust system that goes into follow up on the payments. If you will notice, most of us, especially coming from a middle class, we tend to think that we should not be defaulting or delaying for others' payments. So we will make all our payments, make ourselves go through hell. But we will not put the same kind of pressure when money is due. That is where cash flow becomes imperative. So you may have sales of, say, at a startup level of 50 lakhs. If the money has not come in, then your company is not going to go anywhere. So that is where cash thing becomes imperative.
Yeah, Shriram, I think that's a great point. So what you are saying is that as much as we focus on account payable, we need to focus on account receivable also. What money we are going to receive, and then make sure that we receive on time and plan for that. But more importantly, I think the difference which I see from the chartered accountant and CFO, if I use the word that CFO kind of thing, correct? That, and you have been CFO in few startups and as a consultant, and then helping them to streamline the process. And so chartered accountant typically focuses on more about accounting, balance sheet, and all those financial statements, and making sure that GST is filled on time and income tax is done, TDS is done, which are all critical activities. I don't think there's nothing wrong in that. But as much as we need to do on the compliance side, there is also internally, there is more from a strategic perspective also, there is a need for somebody to understand the finance and then make sure that company gets the right resources at the right time so that it can progress faster. Okay, that's how I would summarize it, correct? So that's great, I think, Shriram. One more thing, maybe if you can just touch on what are the financial metrics which you think that typically startup has to look into it more closely so that they can manage it more efficiently.
Yeah. So at very early stage, cash flow is all about, managing is all about, knowing, uh, what has been the monthly sales, right? Who your customers are, what kind of credit period have you offered? You need to define all these things when even at a very, very early stage. Right? You take expenses. Expenses are going to be definitely going to be more than your income. So you need to break it down into what is necessary, what can be deferred, and what can happen at a later date. The very essential critical ones are the ones where you will need to pull in a team for on the technology side. So there is going to be a pure burn over there. You need to have a basic sales team in order to understand what the product and services that you're offering, so that customers can be brought in. So these are the first matrices that I would look at. While they may technically not be from a cash flow perspective very visible, but this is how a startup journey will have more of expenses initially than income. The matrices that I would look at is, what is the technology team? The founder, is technology going to be in-house? You can't hire people, so the founders have to double up, become experts. So those are matrices that I would see whether how expenses are being spent in-house. Then you look at the sales matrices where contracts are done. How strong are these contracts? So a lot of expenses go into all these kind of things. So again, you may say they are cash burns, but they become very critical because the contracts that you enter into will define how you interact with your customers. So these are some of the matrices that I would look at from a very, very early stage perspective. Once it comes to an angel round of funding, that is post friends and family, next round when it comes to, these startups will typically have sales. So I would look at what is who the customers are. So how many customers are there? What is the repeat business? What kind of stickability is there? Is the money coming in from product or services? Product company, then is there product and services revenue? So at top level, you try to differentiate to see what kind of verticals you can have from the income side. Expenses, then you go to the expenses. Again, as I told you, you're going to have salaries. And the first thing that the founders do is starve themselves of salaries because there's no money to take a salary initially, at least. But at angel level, we would expect partners to take some bit of salary so that they can sustain and keep and not run on an empty stomach. So you look at what the gross profit margin is. What is your EBITDA? So earnings before interest, tax, and depreciation is what typically an angel, when a startup comes for angel round of funding, this is what becomes critical. So if somebody says I'm earning 100 rupees and I'm spending 130 rupees, so the EBITDA itself is negative, then at what levels do you think the company will have a gross margin, let alone the net margin? So typically gross margin should be at least 5 to 12% to start with. If it's a B2C company, then these matrices won't hold. I'm talking more from a B2B or a B2B2C kind of a scenario, where you need to have at least a gross margin of about 5 to 12%. That's something that we look at very, very critically, because ultimately there's going to be a cash. Even at angel round, for the sake of growth, you may have to forego profitability. So even at that stage, one needs to be very, very clear what the gross margins are. For a slightly mature company, once they raise money from angels or from angel funds or micro VCs, let's say the company has a vintage of anywhere from 3 to 4 years, with a top line, of anywhere from 2 to say about 25 odd crores. Because GMV is slightly higher. There we look, the matrices become very, very different. So we look at cost of goods sold very, very minutely, because that's what determines the gross profit. And all the other recurring expenses for growth. So these are some of the things which we minutely monitor. And it's a trend that we see. So it's not a 31st of March audited financials. So month on month, we look at numbers. That is the reason why we ask for a detailed breakup and go through the numbers and see whether costs are coming down or at least have stabilized, and whether the income is, the trajectory is looking upwards. Profitability, of course, for a startup, that's not one of the very strong matrices that even at VC level of funding they look at, but the concept has to be fixed. There should be an upward trajectory of income, and a gross margin is maintained.
Yeah, thanks, Sriram. I think you covered this in so much detail, that as a technologist, also our heads will start spinning kind of thing. There is so much to do as a CFO, and so many areas are there, and so many, I think you can really drill down into deep dive into different aspects of the company. And there is also, I think there is another aspect is that pre-funding and post-funding, correct? That and pre-funding is always the struggle will be there. How do I make my two ends meet kind of thing, if I do use that word, no? Versus the post-funding, it is more about, I have got a lot of money now, how do I work wisely kind of thing and don't splurge. So if you have to give some advice to startups, which are struggling with the cash flow, and I'm assuming that maybe for the pre-funding stage kind of thing. So what are the couple of advice which you give it to them, no?
So Sanjay, I would take it for both pre-funding as well as funded companies, because cash flow is such a critical thing. As you said, most people go with their chartered accountants, but that is the difference between finance and accounts. It's like marketing and sales. It gets mixed up. Same way finance and accounts gets mixed up. Accounting is typically a post-mortem of what has happened. An event has happened, you're recording, and you're then dressing it up the way it has to be presented. Whereas finance is more forward-looking. That is where the CFO's role becomes that much more critical. So at a very early stage, startup stage, an accountant would typically mean getting some basic compliances done in terms of GST and TDS and other things that need to be put in place. But they're not focused on cash flows. So what do you mean by cash flows? So typically, I'll give you, so I became a de facto CFO for a startup, primarily because when we started out, there was no focus on cash flow. Business was being done, on numbers basis. So I had a team that came in and said, hey, listen, I did a sale of 5 lakh rupees for the month, right? I said, very good. So where is the money? No, sir, this is only a sales. What do you mean by sales? Sir, business, I brought in business. Sir, business lie on, man. Fine, your bill. When will the client pay? Sir, client pay karenge. So this went about 20 days, 25 days. And I said, when is the payment going to happen? Sir, usne payment abhi tak kiya nahi hai. I said, but who has followed up? Typical questions, right? People are shy. People don't, since they are, generationally, these are entrepreneurs who have not worked for longer in corporates. So for them, asking becomes an issue. So then I said, when will the client pay? Sir, I don't know, sir. These are typical startup initial days employees. This is how they talk. And when you ask the founders, what is happening? When is the money going to come? Sir, we spoke to them. They said that they have some issues. They will pay later. I said, you also have issues. Who's going to pay? Who will pay you? So these are some of the major factors that that go into a cash flow management. So one has to know that even if you put a sales number on the Excel worksheet, I'm sure most startups initially will not have Zoho or any CRM package. It will all be maintained on Excel. So they will have sales of 5 lakhs. Expenses, let's say, is 3 lakhs. They'll say, sir, profit is 2 lakhs. Very, very typical. Sir, हमने इतना बनाया, हमने उतना बनाया. At the end of the day, when you go to ask them, where is the 2 lakh rupees? Balance sheet में दिखाओ. आपने P&L में तो दिखा दिया ये. Show us where these things, where the 2 lakh appears on the balance sheet. They have absolutely no clue. It's shown as debtors, which is outstanding. And unless you convert that into money, it is not profit realized. So the first step that most startups go wrong is in not having a system where they know, every day, even if you don't have a system, you should systematically every week on the whiteboard. I've seen most startups having whiteboards, at least in the founders' rooms. They should write down, when is money due? If it is not due, pick up the phone, write emails, follow up. Only then will money be realized. And only when that money comes in, will you be able to put money back into your business so that you can address more customers. You can address your employees for the salaries. You can put more money into tech. Right? So this is all at pre-funding stage. It's your own money. Right? So when the founders take this seriously, sales is not enough. Sales realize that becomes very, very, very critical. And that is what, if you're able to plug at 5 lakh rupees of revenue, you will be able to handle 5 crore revenues easily. Because it'll get into your blood that you have to ask to get your money. Right? That is how you streamline cash flows. Now, if you don't do that and keep burning money, how long can you sustain yourself? And if you don't have funding, because family and friend round will limit themselves only to that amount. Beyond that, if you want to bring angels, they will look at the business. If the business is not able to generate money, I'm not saying sales, if it's not able to generate money, no angel will put their money into that. Why will someone chase a losing entity? Is what an investor will think of. So the company that survives this tough period and starts getting cash flow, positive or negative could be different, but there has to be a movement on the cash. That is where at the startup level, pre-funding level, this system becomes very critical. Take just complete that.
No, Shyam, I just want to just barge in just here because I wanted you to share that story of you made all the CEO and the management team to go around to the customer and wait there till they give a check. It's a very powerful story which you are sharing with me.
Sure. So this startup where we had, as I told you, 5 lakh rupees was the invoice raised. So I said, where is the money? Continuing with that statement. So very beautifully, that person said, sir, by sales. He took a sheet of paper and said, sir, ye sale to hai. Right? Then I said, to salary on the left-hand side. And I said, your salary is also paid. Right? So, that is what made them understand that it's not just recording of a sale or, recording of an expense. It is physical movement of money in both the cases that make the difference. So I said, what are you going to do? Sir, wo phone nahi utha raha hai. So this team of mine was seated in Delhi and the customer was based in Chennai. And happily they said, sir, wo to Chennai mein baitha hua hai. So they are not picking up our calls. They're not, and whenever they pick up, also they said, agle hafte de denge. In typical Delhi style, sir, wo to de denge sir, agle hafte. But that never happened. The next week never came. And mails were never answered. So I said, what is the next step? What are you going to do? Sir, we'll continue to keep following up. I said, that's rubbish. Book a flight, go sit in front of the customer. That is when you can realize your money. Sir, but your flight cut ticket is 12,000 rupees. If I have to go there, I have to stay in a decent hotel. Even if you take an OYO room, it should be about 2,000 rupees a day. Let's say I need to be there for 4 or 5 days. I have to eat, I have to travel. Sir, ek 25,000 rupees lag jayega. I said, book your flight, go. So use the credit card, use my credit card. I said, go sit in front of the customer and then call me. The moment they went to the and sat in front of the customer started feeling the pressure. So he said, I'm giving a check for 2 lakh rupees. So this guy very happily said, thank you, sir. And then called me up. I had informed him that whatever check you collect, you please inform me. Sir, 2 lakh rupees ka check aaya, sir. He said, good. Baki 3 lakh ka kya scene? Sir, I haven't asked him. I said, go and ask them for a PDC. वो क्या होता है सर? Post-dated check होता है. In those days, maybe he didn't understand what a PDC was. Today, by the time you come out of your college, you are already on an EMI system, so you're used to the PDC word. But in those days, PDC was not known to him. So we actually collected a post-dated check for 3 lakh rupees, which was 20 days away from today's date, right? But once the check was collected, the client cannot default, because if you deposit check and it bounces, he is liable under Section 130. So these are some of the things that I had to hammer into their heads, that never take no for an answer. Like how, I'm sorry, but Gogo jo hai, Crime Master Gogo jo hai, kuch to leke jaunga. That should be the attitude. Aaya hun sir, kuch to leke jaun. So that is how the 5 lakh rupees. And then people started understanding what it was. So we said, if you want your salary, ensure that collections are done. So for people who had to get their first salary of 10,000 rupees, we said you have to have collections. First, the company has to survive. Pehle 10,000 laoge, company khadi hogi. Iske upar, so you will get a salary of 2,000 rupees. So irrespective of whether he has done a collection of 7,000, 8,000, he gets no salary. 10,000 aaya to 2,000 rupees milta. Anything above 10,000 to 50,000 rupees, we had structured a scheme where the employee took 70%, the company kept 30%. 50,000 to a lakh, we had said, if you did anything above that, you can get an 80% revenue share of that money, and 20% comes to the company. Single-mindedly, along with the founders, we made a transition. And even today, I can tell you that company is bootstrapped. We have not raised money from outside sources. And the company is profitable for the last 6 years. Out of the 7 years, 6 years has been profitable. It has survived on its own. Today, it is doing revenues of upwards of about 18 crore rupees and profitable. So that is where, the founders also were, found value in the cash flow. It was a tough decision. Performers made more money. They stuck around with the company. They lost a few employees. But hard fact, if I have to survive, then the losers have to move on.
Yeah, great story, Shriram. I think the one advice you will then to the founder is if your monies are pending, go and sit on the head of customer till it money gets paid, kind of thing. Well, that's the most critical thing for your survival and your company's survival, kind of thing. Correct. And don't take salary if you don't get the collection. I think that's for the employee and the founders also.
Yes. See, again, and what a founder does is even if he doesn't take salary, he tries to keep the company alive. But an employee will not be that. An employee will move on.
Correct. Correct. Yeah, very, very good advice. So we have got another live example, Sriram, from LinkedIn comments. So this is Abhideep Chakravarti, and I'll just read it verbatim. So he has a company which gives a digital menu to the hotels and restaurants with a very small ticket size of 3,000 rupees per year. And he has got a 5-star hotels as a client. He's himself is a tech guy, which is kind of typically we see in the startup world. Sales is in very bad shape. So I'm trying to make it better. 2 of the 5 stars just renewed their 3rd-year subscription. My cloud cost is rupees 100 per month. That is about 1,200 rupees per year, excluding my Google Workspace cost, and I am not taking any salary. How badly I am doing? That's his question. So if with this parameter, would you say he's doing very bad, bad? I won't say it's okay or good also. I won't get into that scale, give it to you, that scale also.
See, very bad, you wouldn't be seated here asking this question. So you're somewhere between, could be doing better to entering into a bad zone. So let's put it that way. Because very bad is then you would not want to continue. So so that's stage number 1. Number 2, if sales are not improving or increasing, then cash flow can come only from sales. So you'll need to revamp the sales team. The go-to-market strategy has to be in place. Anup, our co-founder, works tirelessly on the go-to-market strategy. Tries to make founders understand that sales is different from marketing, because like finance and accounts, sales and marketing grossly misused. People don't know what people mistake sales and marketing to be one and the same activity. So marketing is long-term, devises strategy, and sales executes that. So go take a look at your marketing strategy again, because you've not found your right customer base. If you think that everybody, the world is your TAM, SAM, SOM, total addressable market has to be sat and clearly defined. So until that stage is done, sales is not going to go up. So at 3,000 rupees, at 1,200 rupees, well, you may not be able to expand the team, but what kind of lifestyle will that be? Even if you're profitable, it would just even if you were to take a family of 4 for a dinner, I think 3,000 rupees would just disappear. Not able to hear you, Sanjay.
Yeah. So he's given some more context around that, but I think primarily what you are saying is marketing and sales is a problem which he needs to solve it. He said he has tried with a co-founder that it didn't work. Yeah, I think we'll have sometime these sessions, particularly in the marketing and sales segment, also on how startup can grow with the help of marketing and sales, particularly with LinkedIn and other social platform. And Anup is an expert in that. So at some point in time, we'll bring that also and then discuss more about it. So I think the next question is from Vinod. What is heard from the speaker is angel round. So my understanding is find some investor and get some money for company investment. Just want to understand more. What is the angel round?
Okay. So, typically when you look at a startup where it's at proof of concept stage, has moved into a minimum viable product, which is the MVP stage, The ones who believe or want to put money into the startup goes purely by him or her knowing the founder. Simple. The founder's capability. If I, as a friend, figure or as a family figure out that Vinod is great guy, his ideas are brilliant. So only family and friends would validate that because they know Vinod very well, right? Once you take the company, improve the sales, get customers, uh, cash flows moving. You need to grow the business. So you want to put more money into marketing. That is when an angel round. An angel round is somebody who will not go merely because he or she knows Vinod. They may not even know who Vinod is, or the co-founders are, or their family and friends. They will go purely by business. They will not look at what Vinod has done in the past or they will look at what Vinod has been doing in this current startup and validate. So that is where the product market fit becomes very, very critical. There are customers, there are revenues, there is a possibility that the products and services are being liked. The business model works, the revenue model works. That is when angels will come in. Let's say a typical very early stage angel would be anywhere from 50 lakhs to a crore. Institutional angel round of funding typically happens a mix of angel investors or at a 2 to 3 crore fundraise, where again the business model is validated, the revenues are there. There is a scope that the total addressable market can be increased, or even if it is not increased, your serviceable clients are increased from the TAM. That is where the angel investors stroke angel fund will come. I hope I have addressed that for you.
Yeah, Shriram, I think one of the critical thing, and I'll just we digress a little bit on the angel round and we have few videos around that in last time when we had done it. And I would suggest that you can go to our Sen Angel LinkedIn page. You will find those videos about the different rounds of investment and how do the investor evaluates the opportunity to invest in the startup into more details. No, so we have on both the channels on YouTube and on the LinkedIn. So either of channel you can use it. No, so coming back to again the cash flow management. I think as much as we talked about the cash flow problems and how to focus on the sales sides and account receivable and make sure that we get the money paid. So how do startup avoid the cash flow problem when the unexpected expenses arises? No? And this kind of get links to the cash reserve also, correct? Because that's also is another aspect of it.
So again, I will go back to the same example that I gave of the earlier startup. So we started in 2016, and in the first 15 months, that is the time that we actually burnt money. Subsequent years, we've only been profitable. So close cash reserves also become critical. Whether you have raised money or whether you have or whether you're bootstrapped, money is only finite. It will get blown if you don't provision or make reserves, right? Suppose you raise 3 crores, if you recklessly put it into growth and not be bothered about cash flows or cash revenues, it becomes very, very, very challenging. So in the startup that I've been speaking about, in 2020, when COVID hit, this is a non-tech company, and lockdown for 6 months. Forget about business. Nobody was allowed to even step out. Right? So and at that time, people have easily said, "Hey, listen, guys, we can't pay you salary. Sorry, we're not earning anything." That will bring down the morale of your employees, right? And especially guys who performed and brought you to this level. They would start looking around for other opportunities. You can't blame them. They would want their cash flow to be in order, personal cash flows to be in order. So that is where we had built up revenues. And for 6 months, believe it or not, every employee was paid. The CEO and the management team, if I'm not mistaken, had not taken money, but they ensured that employees were paid salary, even though there was no sale. So they were literally burning whatever reserves they had had. Now, what did that do? Once COVID norms the lockdown was lifted, the employees then started running because they felt this is a company that took care of me. So the company business just doubled. So what was lost in the first 6 months, we had the same number in the next 6 months. So the company had in the previous year done revenues of 4 crores. And the first 6 months was lost in the subsequent year. Next 6 months, they did 4 crores. So technically 4 crores to 4 crores may not show growth, but that was in 6 months. That laid the foundation where it moved to 15 crores to 18 crores. The trajectory has only been going up. But yes, the CEO and the management team had taken steps to ensure that we had built small reserves every time. That helped in a very unforeseen circumstance when COVID hit. I mean, nobody could predict that COVID was going to hit. Dial a loan in 59 minutes. That was one of the schemes that government had brought in. So as a banker, as an ex-banker, I said, why don't you try? Because at the end of the day, startups don't have those numbers or vintage which a banker expects. So banking has its own norms. So that is the reason why startups don't qualify for banking. But here we had dial a loan in 59 minutes. We had an approval in less than 59 minutes. Didn't get a loan in 1 year. So how do you factor in all these things? So one has to have those reserves so that you don't spend everything in one go at the cost of just, in the name of increasing revenue, you need to be careful. That is where I would suggest startups tuck something on the side. And I would also say that the founding team should take some salary. It will keep them on their toes that they have to keep generating revenue.
Great, Sriram. Sriram, I just want to make sure that we have another 15 minutes and there are some critical questions which I would like you to answer so that it can benefit the founders. I think cash doesn't mean that only revenue, correct? That's one part of it. And that's a critical part because that's where you don't need to do anything. You just get it. But there are several ways of managing cash strategies could be there. One could be like you mentioned about credit card. Funding could be another one where you can have a debt funding and equity funding. So maybe you can talk about the different strategies to manage a cash, because that would help the early stage startup also. There are different avenues where make sure that the shops keeps running. I say that kind of thing. If you don't have cash, there is very likely the shop will get closed. And then if it gets closed, everybody, including founders and the team, go through the trouble time. So it's very, very critical that in your bank account, there's the money is there to pay the salary to your employee at the end of the day kind of thing. Right? So there are different strategies are that to manage that. Working capital could be another one. So maybe if you can just talk about few of those strategies, no?
So at SAN, we have tied up with a large multinational bank. We are working with them in providing certain basic packages so that reconciliation becomes easier. This has nothing to do with cash, but technically it shows how the cash is coming in, how the cash is going out. So your contracts is the first thing that I would look at. So when you're providing services to your customers, if you have a 45-day cycle or a 30-day cycle, also remember that salary comes after every 30th day, right? So you have to know when the money is coming in and when the expenses are going to happen. That's why I said whiteboard, weekly, keep writing what your expenses are going to be. The side, monthly, what expenses are due the following month. What kind of collections have to be done. So that is as far as cash flow is concerned. But various ways of tiding over that, yes, debt funding becomes challenging for startups that don't have too much of revenue. Right? So if a startup, let's say, has a business of, let's say, about 8-10 crores, right? You can approach a bank and tell them, hey, listen, we would like to avail some banking facilities. First thing that the banker is going to say is, give me 3 years of audited financials. 2 out of 3 years have to be profitable. Do you have it or not? No, I don't have it. Out. Right? But again, do you have collateral? No, I don't. I have started, this is a startup where I have not built my resources. I'm only 25 years old, or maybe 28 years old. So I don't have a collateral that I can offer. So that immediately cuts the banking route. So you need to approach. There are some small, again, startup finance companies where they do some structured funding. So we have done structured funding where we did invoice discounting, bill discounting for a logistics company. They raised $30 million, but they were using that for working capital purposes. So made them use the money for growth purposes, and we tied up bill discounting and invoice discounting for these guys because they had some wonderful sets of customers. So it gave us the leeway to do bill discounting, invoice discounting facilities. Did it through NBFCs, we did it through banks. The company was doing revenues of GMV of 177 crores in the first year, and they had about 100 crores of invoice discounting. Using that, the next year revenue was about 700 crores. So that is how they effectively made use of invoice and bill discounting. But they were not eligible for overdraft or a credit card facility, which could be offered by banks only to profitable companies. Then you have companies like Recur, which do revenue-based financing. You should be able to tap into every bit of it because even if you have a term sheet, does not mean that the VC or angel round is going to close. A lot of things could slip in the crack because of unfavorable due diligence report. There could be multiple factors. Right. Today we're going through winter funding, new terminology that we use. So how do you type through all these things? You need to have cash. Another thing is with the institution that we have tied up with, we are working to provide credit card. It's actually a charge card where they give credit facilities up to 52 days. So your travel expenses, these kind of expenses which can be charged using the charge card and paid for a max credit period of 52 days. So that is another avenue that we are enabling early stage startups with. Also, when you have a term sheet and there is a delay in the funding, there is venture debt. So they come in when you have a term sheet and they're dead sure that the equity round is going to happen. They fund you in that interim gap. So it's not like a debt. It's a bullet repayment because for the money that you're going to get from the VCs in the interim period, they fund you. So you have to find a lot of avenues. One typical mistake that founders typically do is going for private finance. They think that their margins are so good. I've met with some founders who say that their EBITDA margin is 86%. so I can afford to take a private finance, and a private finance comes at a huge cost. So my advice to you would be to, unless you're sinking, that's the last resort. Don't go in for private financing. Look for advisors who can tailor make solutions for startups. At SAN, that's the advisory that we provide.
Great, Shreyam. I think Suprit Kashyap, he came out with a very interesting perspective. And I just want to quickly touch base on that pricing, correct? As a startup, you need to look at your pricing also very carefully. But sometimes in the enthusiasm of selling and then getting the revenue, maybe you are not pricing at the right time. And many, I think sometimes also, if you are tech founders and not having experience in pricing the product, you just see what is my expenses plus some margin, and then I kind of want to sell instead of what market can give you. So if market can give you more price, and if a product is having a demand, maybe you want to price it appropriately. And that's another way of ensuring that you don't bleed and put it at the right time. Another thing is maybe you are just looking at gross profit margin when you are doing a pricing. Are you getting unit economics right?
Absolutely.
I think that's the most critical thing. If your unit economics is bleeding, then your company is going to bleed and then come to a grinding halt. So those are the few things maybe you want to just look into it while you are looking at the complete aspects of the cash flow management. No, I want to quickly, I think we have about 9 minutes, Sriram, want to discuss about post-funding scenarios of cash flow management, correct? Because we looked at the pre-funding, and that's rightly so, because that's where a lot of pain is there in the startup ecosystem. So we spent almost 50 minutes on that pre-funding. But let's look at post-funding. So once you get the funding and the startup founder starts feeling quite happy about it, like now I have $1 million in cash in my bank account. Now, how do you manage cash during that time? No,
That's like a poison, Sanjay. So one needs to be absolutely careful, because cash can either be sweet or it can be a poison. Again, you are driven by the round that you raised. Let's say $1 million round raised with a lead as a VC. If the VC is going to be driving the go-to-market strategy, says burn more money, I want to see more growth, the founders have to take a logical step in managing their cash. Will it be pure cash burn? At the expense of cash burn, are you going to grow? Again, like how you mentioned, earlier it could be a freemium model, so they may not have the pricing. But once you get the pricing in place, sometimes you could be driven by sets of investors who could sit on the board and tell you, hey, listen, I need you to reach these levels. If the unit economics is not making sense, the founders have to step back and say, hey, listen, this is not how the founders have to take by that. If you're raising $1 million, then you will have a quasi semi CFO in place. If you don't have a team that has a finance professional as a co-founder, you will have somebody senior who's going to be doing that. So that is where so collections, all the things, as I mentioned earlier, will continue even for this. It is not that pre-funding has certain things and post-funding. So these are all the things that every company has to have, right? At what stage would you want it to turn profitable? That is where the founders have to take a call, because next round of funding will happen only if you touch. So suppose you're doing 5 crores, you have raised 8 crores, and they said, we should touch 50 crores. Is the business sustainable if you are going to be doing 50 crores and burning, let's say, 25 crores? You have raised only 8 crores, and you're pulling in another 17 crores from the business. So those are things that one needs to be careful, because as you keep growing, the hole keeps getting bigger. And the moment it starts getting bigger, it's not like a cloth where you can stitch it back, where you can put another cloth on top of it and stitch it. The hole just keeps getting bigger and wider. That is where one has to, as a founder, needs to be sensible and have money in the bank. This is
Sure.
This is a very, very critical thing that I would say. So while VCs have put in money, while VCs will be sitting on the board, or angels will be sitting on the board, the founder has to have basic principles of their business.
Yeah. And Shriram, I would tend to put this in a 3 buckets. So once you get the money, you need to look first is the financing. You might have taken a debt in a pre-funding phase. Now, how do you retire that debt? How is going to be, so that the burden on your company gets reduced, right? That's the first part of it. Second part, like infrastructure, you need to build for the growth, for the next phase of the growth. And there the technology team, if you have any cloud infrastructure or whatever you need, so that your next phase of growth is kind of managed properly. And obviously, third is more operational activity like working capital. Do I need, if I'm going to grow 1 to 10, what kind of working capital requirement I would have, and is this cash I will need for that working capital? So if you start putting that into smaller bucket, you will not see one big amount of $1 million. You will start seeing 1 crore, 2 crore, and then you will be able to say, okay, I need to be cautious about how I spend my money. If you see one big ticket item, then it becomes difficult to manage, but you start putting in smaller buckets.
Again, I would advise the first bucket that you had, whether to prepay or repay the debt taken at early stage. You have to evaluate whether you have adequate cash. Even if the debt is, say, 2%, I'm just saying 2% per month on the very high side, an unsecured loan that you have been able to get. If it makes sense to take the 2% interest into your P&L, I would suggest don't prepay, because cash is king. So by prepaying, again, you will get into a catch-22 situation. The crunch will. So it's a cycle. I'm not saying don't prepay. If you can replace that with a cheaper debt, try that first. If you can get into equity, prepay part of the high cost debt, but never prepay. It's not like a housing loan where you go on, where you bought one house, you have a steady cash flow, you go and buy the second house. No. Here, the business environment doesn't allow you to prepay, even if it is high cost. But of course, it has to be a sensible mix of cost and liquidity.
Yeah. So, Shriram, we are coming to the close to 1 hour. I think it was fascinating discussion with you. We started with the cash is a king, and then we are ending with the cash is a king. So that statement is not changing. But maybe I think you just have your closing comments and some of the common cash flow mistakes which startups should avoid it. The basic mistakes kind of thing. That will be good for everyone to know about it. No?
Again, I covered that. So basic mistakes are when the founders don't take salary. They think they're doing a great service. In my opinion, start hurting yourself and everything goes downhill. Start hurting the system. The system will start shouting at you. It'll make you work harder. By you taking that money, whomsoever has given you money will start shouting at you. That will keep you motivated to do more business. Go ask, sit in front of, you need to be shameless. You need to be thick-skinned. That's the first step of being an entrepreneur, right? So do that. As far as possible, start taking salary, however small, right? Another thing I would very strongly tell non-finance founders, just take up a small course, 3-month course, understand what it is. Because at the end of the day, you can have a great technology, you can have great teams, you can have great sales. If you did not know how to manage money, it can come crashing down. And I've seen this as a banker in small and medium enterprises where these businesses have been there for 8-10 years and suddenly have lost focus, they've just folded. Right? So do some basic course, understand terminologies like how investors learn startup jargons, learn a few things. The startup founders also have to learn the basics of finance and accounting, like how they have to learn the basics of marketing and sales if they don't have somebody in that space. These are some of the things, common mistakes that we see. Another thing is not following up or having a dashboard. Or a dashboard need not necessarily be in front of on a computer. It can even be on a board. You should know when your payments are due, when your uh, customers need to pay you. And keep looking out, talk to people, have advisors, have mentors who can bring you that extra dime in terms of debt, in terms of structured funding, in terms of equity, in terms of quasi-equity, can be anything. But have somebody who can arrange for funding on that space. And you can be frugal, but you need not necessarily be cheap. These are some of the basic mistakes that I noticed. Typical startup founders at early stage. When it comes to when you have too much of money, parties. These used to be the norm of maybe 2-3 years pre-COVID days. Nowadays, at least I don't hear stories of that. But in those days, once they raised $2 million, that was a huge party in the office. Somebody went and bought houses. The money is not meant for purchase of a house; it's meant for the business. So those are all the discipline that you bring in will ensure that you move from pre-series A to series A to series B, maybe even to an IPO or maybe sell it out to a bigger company. Those are the mistakes that one has to avoid at early stage.
Yeah. Thanks, Sriram. Thanks for your time. So I will just say with this closing comment is that cash is a scarce resource. Use them wisely, and once you use it, control them afterwards, kind of thing. Otherwise, you'll be again in trouble. So absolutely. Thank you, Sriram. Thanks a lot. Okay.
Thanks, Sanjay. Thanks, everyone.
Thank you.
Bye.